Hi there, welcome to Neppy Invest and welcome to another technical update video. This has been the standard for all my Sundays over the past few years to release this type of video, looking at charts, lots and lots of charts, and today is no different. We'll go through the usual array of indices, Australian, American, international, then we have a look at commodities, also have a look at crypto, bonds and currency. And when it comes to individual companies charts, we'll be looking at some high quality companies whose share price is near the 200-week moving average. Now, some of these companies you might not consider high quality. We'll be looking at ASX companies, also companies listed on the NASDAQ and New York Stock Exchange. So no international companies, but quite a few of those have been popping up recently. Okay, so let's get into looking at the Aussie indices, starting with the XJO. 4 down weeks in a row. In fact, we've seen the XJO down by more than 1% during those 4 weeks, down 3%, down 1.5%, down 2.7%. In the past week, down 1.99%, not quite down 2%. So 4 weeks in a row that the market or the XJO has been down by more than 1% in a row. And this doesn't happen all that often. In fact, I quickly went through the last 20 years just to see how often this has happened. And yeah, it doesn't happen all that often. You will see a lot of times the indice down 3 weeks in a row, 2 weeks in a row, but 4 weeks in a row down is quite unusual. And I did mention on Friday, I think, or maybe it was yesterday, that the XJO is oversold and we can expect a bounce. And then lo and behold, on Wall Street's Friday session, they had a really good bounce. So I do expect a good week. I expect next week to be green for the Aussie market, just because we need that bounce. Now, last time this happened, 4 big down weeks in a row, because we did see the XJO down 4 weeks in a row. But, you know, if you go back to late 2022, it was down 4 weeks in a row there, but we're talking about it down one of those weeks by 0.57%. In the start of 2023, it was down about 6 weeks in a row, but some of those weeks it was down, by 0.32%. So I'm talking about 4 big down weeks in a row. And the last time this happened was, of course, COVID-19. 4 big down weeks in a row there. And then you have to go all the way back. Yes, all the way back to the GFC. I thought maybe in late 2018, but even in that period, the NASDAQ corrected 23%. Our market also fell, but we didn't see 4 big down weeks in a row. In fact, we saw a few big down weeks. So for instance, October, 8th of October, it was down 4.7%, but then the next week it was up 0.74%, and then the next week it was down 4.62%. So a lot of volatility during that period, but we didn't see 4 big down weeks in a row. So you do have to go all the way back to the GFC. Now, maybe I missed one or two. There is a chance I missed one because I went through this fairly quickly. I'm just trying to see if I can see anything. Oh, no. Or maybe here, maybe not. There was 3 big weeks in a row, down weeks there. So you do have to go back to the GFC. And interesting enough, during the GFC, there was one period where the XJO was down about 10 weeks in a row. But even then, there was 1 week where it was down 0.97%. And that was in the middle. So even then, we didn't see 4 big down weeks in a row. So there was a fair bit of volatility there. We saw a lot of bad weeks, but then it was followed by a good week. A lot of bad weeks followed by a good week. So this run of down weeks in a row is really rare. So I do expect a bounce. And I did mention we are oversold. In fact, I even showed you the RSI. So if you have a look at the RSI, here it is. Our market is oversold. That's the weekly chart. It's not actually oversold the weekly, but definitely on the daily chart, it's highly oversold. Look at that. Massively oversold. We don't see it this oversold all that often. The last time we saw it this oversold, was back in June 2022, near the bottom. And of course, probably during COVID-19, yep. And probably sometime in 2018, yep. Got pretty oversold back in October. Yeah, so it doesn't happen all that often. And usually if it does happen, you see a bounce. Now, how healthy this bounce is, maybe not healthy, how strong this bounce is, it remains to be seen. It could be a really weak bounce, and that could be troubling. But I do expect a pretty good bounce and a pretty good week, I think. I think we're going to have a pretty good week. I would expect, if you have a look at the daily chart, I would expect us to move back towards the 200-day moving average at least. So we're talking about maybe not a 10% rise, not this week, but might go over a couple of weeks. I wouldn't be surprised to see a 5% bounce over the next couple of weeks. By the way, if you do have a look at the weekly chart for the XJO, and this is something I do look at when it comes to individual companies that are of high quality. And if you do assume the XJO is a high quality index, the good time to buy stocks or companies within the ASX is when the XJO is below the 200-week moving average. It doesn't actually happen quite often. And right now, it's still quite a bit above the XJO, but it is moving towards that. Now, right now, the 200-week moving average is about 7,400, so still about 5% above that particular level. But we are now in the middle of almost the middle of the trading range, which has been in play for 15 years. 15 years, yep. Okay, so let's go to, we don't have to look at the XAO because that's almost identical to the XJO. If you don't believe me, this is the XAO. It's almost identical. And let's have a look at the XSO. Only down, not quite a correction for the XSO. In fact, I'll get rid of this downward thing. Yeah, nothing much to talk about. So this one I've kept on the 200-week moving average. I'm not as big a fan of the small caps as, say, the XJO, simply because a successful company within the small caps will actually get taken out of the small caps and put into the XJO or XAO. And that is one of the problems, that the good companies get taken out of the small caps and some of the bad companies get put in because they're fallen angels, that sort of thing. So I don't think the small caps is a really good proxy for small caps. The sort of small cap companies I like, but anyway, it's one of the only indices we have in this space. And there's not much to talk about when it comes to this particular indice. By the way, a really good Friday. The small caps was up. What was it? Almost 1%, I think. Yeah, 1.33%. When the XJO was, the XJO was up, but it was up slightly, 0.52%. So a really good end to the week for the XSO, and doesn't look quite as weak as the XJO if you have a look at the chart. Not quite as weak, but still not strong either. The other three indices I do like to have a look at include the the ASX 20, which is the XTL. This is really weak. Down even more than the XJO, which is telling me with the small caps not down as much, XJO down about 10%, XTL down a lot, and then the banks down 15%. It tells us that the weakness in our market is being led by the banks, which is understandable because the banks are overvalued, and I would even say they're still overvalued. So it's not surprising to see our market has been led down by the banks. And that is the reason why the XTL has had a worse correction than some of the other indices. And this particular index has fallen through the 200-day moving average. It has been above that particular moving average since about December 2023. You'd say that was a breakout. So this has been a bit of a negative move. We'll just actually go and have a look at this. There we go. We also had a crossover in the moving averages. This happened within the last 2 weeks. So it is looking negative, but again, I would say this is significantly oversold and I expect a bounce. So that is going to be the theme of the week. Expect a bounce. If the bounce doesn't happen, bounce, bounce, bounce. If the bounce doesn't happen, that would actually be concerning. Now onto the all tech. This is another really weak area in our market, which is understandable because we do follow on, or companies within this sector follow on from NASDAQ. NASDAQ is really weak, and this particular index is down 17%. And we've just had a moving average crossover. There we go, moving average crossover. And that would be an indication we are potentially moving into a downtrend. At the very least, the uptrend is coming to an end. So the enthusiasm within this sector is starting to dry out. It might take a little bit for that enthusiasm or that positive sentiment to come back. It might take a while. It might just be Trump just pivoting, going from being pro-tariff to being anti-tariff. Who knows what he's thinking? Anyway, so that's the all tech looking negative as well. And of course, the XBK, the banks, looking really negative. This is down by over 15%. And even though some of the other indices were up on Friday, the banks were down. I do expect the banks to have a pretty good day on Monday. I would see a little bit of cash flowing in. I would say there's some people who might think the bottom has been reached. That's the whole definition of a bounce. People get a little bit enthusiastic. They think the bottom has been reached. Now is the time to buy the dip. So this could be, this could be a bit of a buy the dip situation for some investors, but it's all about the strength. How strong is that buy the dip sentimentality? Now, this is fairly similar to some of the other indices, or nice uptrend, and I think that uptrend has come to an end. And it's come to a pretty good end too. By the way, we saw a really bad period during the middle of February, and then we saw the index once it hit a support level, it tried to rally, and that's the definition of a really weak rally. I'll get rid of this line here. You can see that it tried to rally between the 24th and we'll say the 3rd or the 4th of March, and it didn't really get going. It was a really weak rally, and then that rally petered out because it was weak. There was no enthusiasm, absolutely no enthusiasm from buy the dip investors, and that's why we have just seen it fall away, this particular indice. And yeah, okay, so that's the Australian indices. They're looking weak, much weaker than they've looked for at least 1 year. Definitely for at least 1 year. In fact, I'd say it's the weakest it's looked. Even back in 2023, you can see the bank sector or the bank industry wasn't really doing anything. It was just going sideways. So that's not really weak. This is probably the weakest it's looked since March 2023. So we're talking about 2 years ago. And even then, look at that. It wasn't doing anything. Look at all these crossovers, which is telling us it's just a sideways market or sideways indice. How much further could this fall? It could fall all the way back down to like 2,500, 2,600 because the banks are so widely overvalued. By the way, I do have one bank in my individual company part of the video. Now onto the American indices. We'll start off with NASDAQ. And just like some of the Australian indices, we've just seen a moving average crossover. So this is starting to look, again, a little bit weak. Now, we did have a moving average crossover back in November 2023, but that turned fairly quickly. That was sort of a false signal. And the positive moving average crossover was on the 2nd of February 2023. So we're talking about 2 years ago. That was after a period of weakness in the market because of rising interest rates. And that was a time to become really interested, I think, in the NASDAQ. That period between February and March, that's probably prime buying of these high-quality companies in America, particularly on the NASDAQ, and really hasn't looked in trouble since then until now. But again, on a Friday session, pretty good day. The NASDAQ was up 2.49%. Any news flow? Let's have a look. Michigan consumer sentiment. Oh, that was yesterday. Actual 57.9, forecast 63.1. Consumer sentiment is just dropping like a rock in the United States, which is understandable. I'm watching a lot of videos and there are a lot of people concerned. I think the main reason for concern over there is just uncertainty. People, markets, everyone hates uncertainty. Businesses hate uncertainty. What are we supposed to do? We don't know where to pivot. We don't know what to do because of that uncertainty that the current government in the United States is providing. Anyway, so that's why I think sentiment is dropping over there. It's just uncertainty. People just don't know what's going to happen, which is really bad because if people don't know what's going to happen, they could be thinking, I might be out of a job in a month's time. If I'm out of a job in a month, I've got to protect my money, protect my capital. I can't make any frivolous spending, that sort of thing. So if that is sort of the mentality over there, people will stop spending, or they won't spend as much, and that will be harmful to the economy. So that is why sentiment or consumer sentiment is really important because it does sway consumer purchasing purchasing thoughts, whatever. I don't know how to say that. Anyway, so NASDAQ's looking a little bit more negative, but nice little bounce on Friday. How good or strong this bounce is going to be important. And we just don't know because we have seen NASDAQ bounce quite often in the past 2 weeks. On the 28th of February, it went up 1.62%. On the 5th of March, up 1.36%. And yeah, so we've seen these bounces before. Even during the GFC, even during the tech bubble burst, we saw massive bounces. I love when people say you have to be fully invested in the market all the time, because if you weren't invested in the market during the best days, you've lost so much money. But the problem with that thinking is the best days happen during bear markets, and they're usually surrounded by really bad days. So if you're not invested during those really bad down days, you've actually done better. So I hate when people say that, when experts say you have to be fully invested because you just don't know when those really good days are going to happen. Really good days don't happen during bull markets. They happen during bear markets, but they're surrounded by really bad days. Anyway, so NASDAQ, pretty weak, which is follows on from the Aussie markets. Dow Jones, I expect this one to be fairly weak. Another moving average crossover. Also, the Dow Jones fell through a support level, just above 41,600. Again, another nice little bounce on Friday, up 1.65%. But again, how strong will this bounce be? So that is sort of the story about this week. Crossovers, indices starting to look weaker. Are we going to see a bounce? All these indices are in correction territory. Will it become a crash? Will we see the indices down by more than 20%? It's all up in the air now. No one knows. No one knows. I actually did read or hear, or try to hear, I actually turned it off, an interview with Junbi Liu, whatever her name is, Junbi La, I forget. And she said, at the start of the year, there were 3 landings possible, soft landing, no landing, hard landing. Now hard landing has been taken off the table. It's like, what? What do you mean it's been taken off the table? It's more likely a hard landing right now than it ever been before. It was like weird to say hard landing's now off the table. It was weird. I had to turn it off after that. But anyway. Now on to the Russell 2000. So this is a small cap proxy. This one has been looking weak for a while, and this is really understandable. I would say, and I would assume there's probably research done on this, that when the market starts to turn negative, it's the small caps that suffer first. In fact, we saw this in Australia. It happened about 3 or 4 weeks ago when I noticed some of the small cap companies I was holding, they were really weak. They were dropping on nothing much. And that was sort of the signal to me. And we've seen that with the Russell 2000. This one started to look weak about almost 1 month ago. Started to look weak 1 month ago. Yeah, sure, it rallied nicely on Friday, up 2.53%. But again, oversold bounce. So definitely this is looking even weaker than the Dow Jones and the NASDAQ. Okay, so now on to international indices. And yes, so I did get a comment, and I did mention this in my answer and reply video, that some of the international indices aren't looking weak at all. In fact, some of them are looking okay. Relatively speaking, they're looking really strong. So all this weakness, I thought, and maybe assumed, that this was worldwide. No, it's not, looks like. And we can see that just by looking at some of these international indices. And I only will show you 4. Maybe I could. I'm going to have a look at the TSX. Why not? Why not have a look at Canada? Go Canada. We're supporting the Canadian or Canada. So I am going to put this up into the international indices. There we go. Maybe we should be looking at the New Zealand NZX. Which one? Is that New Zealand X50 index? How does that look? Oh, look, it looks fairly similar than the ASX. Maybe not as weak. Now I'll keep it to the Canadians. I'll just have a look at 5. So we're looking at the Japanese, the Nikkei, Hang Seng, the DAX German, the FTSE, and also the Canadian TSX. Is that Toronto Stock Exchange? Anyway, so let's have a look at the Nikkei. This one is weak. Yeah, this one has turned a little bit negative, but not quite as bad as some of those other indices. Now, if you have a look at the Nikkei over the past year, it's done nothing. It's really done nothing. So unlike the Australian indices and the American, which were in uptrends before they started to turn negative, this one is just going sideways. So I disagree with some comment I read or heard, was it yesterday, that the really strong indices, the American and Japanese, have turned negative. And I was thinking, no, the Nikkei hasn't been that strong for a while. It's just been going sideways, and this sort of confirms it. It's just been going sideways for a year. So that's the Nikkei. It has turned a little bit negative. Hang Seng, completely different. This one is strong. This indice is strong. So all these tariffs that Trump has been touting is going to help the United States and the American people. Well, it's not really affecting the Chinese market or the Hong Kong market. So this one is really good. Beautiful looking index, really helped by Alibaba, by the way, which is a company I own. Alibaba looks pretty good. Yeah, I wonder how much correlation there is between Alibaba and the Hang Seng. I'm assuming Alibaba is on the Hang Seng as well. I could be wrong. You know, I might be wrong. I always thought it was on the Hang Seng. But anyway, a pretty good indice. Hang Seng looks pretty strong. And this is a beautiful turnaround story. It was on a long-term downtrend. When I say long-term downtrend, yeah, look at that. Going back to 2021, it's falling, and now it has turned around. It's definitely some positive sentiment within the Hang Seng. Onto the DAX, which is another really positive indice. This has been led by SAP, and I would say there is definitely correlation between that DAX and SAP. Here is SAP. Although SAP has dropped a fair bit. Maybe a buy the dip situation for SAP. But anyway, go back to the DAX. This looks pretty good. And I'm thinking, even though we've seen weakness in the SAP, there could be strength in defense companies on the DAX. Don't know if there is any defense companies because of the significant increase in spending we're going to see when it comes to defense, not only in Germany, but also other countries in the US, in Europe. And you know, sometimes it's awful to say, sometimes war, if we do head that way, when it comes to Europe and Russia, sometimes war is beneficial to the economy in the longer term. Anyway, so the DAX looks pretty good. No real weakness in this one at this point in time. And the FTSE, a little bit weaker, but nowhere near as bad as what we see in Australia and the United States. So just based off the FTSE and the DAX, without looking at the French and the Swiss and the Norwegian and the Lithuanian and the Latvian and the Slovakian and the Albanian indices, maybe Europe is the place to be investing right now. I wonder if Albania does have a stock exchange. Albanian Stock Exchange. There we go. Tirana Stock Exchange. Tirana, I'm pretty sure, is the capital of Albania. Oh, wait there. The Tirana Stock Exchange is a defunct stock exchange in Albania. There you go. It's defunct. It is currently not functional, has been shut down since 2014. Dear me. I'm sorry. Can't invest in Albanian companies. Or maybe they're listed on another country's exchange. Okay, and on to the Canadian Stock Exchange, the TSX. This one is not as bad. Yeah, not as bad as, again, Australian and American, which is unusual because I would think there was a fair bit of overlap between Australia and Canada. We are fairly similar companies or countries, mining rich, and I would also like to think that a lot of the makeup of the Canadian exchange is financial. They do have an amazing, absolutely amazing software company in Canada called Constellation. For those who have never heard of this company, Constellation, what's it called? I'm assuming this is on the TSX. It could be dual listed. What's it called? Constellation. It's in my, I know it's definitely in my international. Constellation Software, TSX. This company has a market cap of almost $100 billion, but have a look at this weekly chart. This is the sign. This is the quality of a high-quality company. This goes back to 2010. You could have bought this company at a price of $47 in 2010, and it has been a 100-bagger since then. Almost exactly 100 bags since then. This is a company I have been following now for a little bit, and I just go, oh, God, I want to buy some shares in this company. It is expensive, but this is the definition of a high-quality company. So I'm not sure if it's also dual-listed. I should find that out, but I can buy this company on or in my super. Maybe I should just buy some shares. Brilliant company, and we haven't really seen a pullback. Yeah, if you look at the daily chart, no significant pullback with Constellation Software. It's just a fabulous company. They just buy more They just continually buy software companies, and it's just been successful. Will it run out eventually, that sort of model? Well, yeah, not yet. Anyway, on to... So we've gone through all the indices. Now onto commodities. Start off with gold. What can you say about gold? It just reached a high on... It's just reached a new all-time high on Friday. What's there to say? Gold is bullish. Gold is good. Gold is great. I'm not complaining. I have a few gold companies. Maybe I should have more. I've been thinking about it. But gold just looks brilliant. It's just a beautiful chart for gold. Not only the daily chart, even the weekly chart looks absolutely gorgeous. Maybe the only thing you could say is if you have a look at the 200-week moving average here, it's well above the 200-week moving average. So eventually it is primed for a little bit of pullback, but who knows when that pullback is going to happen. And if we continue to see geopolitical tensions in the world, gold could be the place to be. So beautiful, beautiful commodity right now. Well, I should say beautiful commodity. Well, I suppose it is a beautiful commodity, but also a beautiful chart. But it is a commodity, and I would say eventually the good times are going to come to an end. And if you have a look at the monthly chart, I still remember watching the Sky News Your Money, Your Core back in the early 2010s. And at that point, you can see gold was in a downtrend at that point. And the amount of times I was talking about gold, because gold was having some good days and really bad days. As I said before, when it comes to the stock market, the best days usually happen in bear markets. And gold during that period between 2011 and about 2015, some of the best days gold has experienced was during that bear market in gold. You can just see it. Gold fell from about 1,900 down to 1,000 during that period. So a lot of talk about gold during that time period. But that's the sort of thing you want to say just by looking at this. You want to see a pullback. That was the time to get excited about gold, and it is maybe getting a little bit too stretched, gold right now, but you just don't know. So gold is looking brilliant. You would think if gold is looking brilliant, silver should look brilliant as well. Not so. Not quite as good as gold, but still looking okay. Still looking okay. I'd love to see gold get above $35, which was the highs we saw. Silver, did I say gold? I'd love to see silver get above $35, which was the highs we saw back in October. And it is heading towards that direction. So silver looks good. If you have a look at the monthly chart for silver, you can see a pretty massive pullback. Remember how gold had a pullback, went down about 50% from 1,900 to 1,000. Silver went from 48 down to 14. So silver's way more volatile, and silver hasn't got back up to those levels. Anyway, so maybe silver is the way to play gold, because I do think potentially it will catch up. But silver, not quite as good as gold, but is looking okay. Copper had a really good day 2 weeks ago and has broken out. I was saying if copper could get above this horizontal dash line at $4.80, that was a nice little resistance area or zone. It has got above that during the week. And next, I want to see get above these highs we saw back in May 2024. So that's above $5. But this chart looks pretty good. I do like this chart for copper. Let's have a look at the weekly chart just quickly. Yeah, I'm not as enthusiastic just by looking at the weekly chart, because it has been going sideways for about 4 years. But still, daily chart does look promising. We'll say promising. Now onto iron ore. Iron ore, yeah, I was going to say it fell through $100 not that long ago or during the week. There's nothing much to see here. There's no trend. And you can just see all the moving average crossovers, which is a sign of a trendless thing. There's no trend here, just going sideways. And the more moving average crossovers you see, the more trendless it is. You don't want to see a moving average crossover for like a few years. Well, if it's an uptrend. Anyway, so no trend when it comes to iron ore. I don't have any iron ore companies in my portfolio right now. And if I do see a nice little trend beginning, I will think about it. I was thinking about BHP, because BHP was below $40. And I was thinking You can see BHP has actually been in the downtrend for a while, but then I was looking at the weekly chart and I was thinking, if it falls to like $37, that would be a nice little buy point. So between about $36, $37. But and the other thing I should say is if you have a look at the 200-week moving average, it has just fallen below that. But the problem with commodities is sometimes you'll see the commodity fall below 200-week moving average and stay well below it for a long period of time because of the underlying commodity. So I would never, ever consider mining companies to be high quality because they're beholden to the underlying commodity. Anyway, it's really interesting. BHP, I think, considers copper to be more important than iron ore. And the reason I say that is because in any sort of presentation they do release, they always mention copper first. And it's really interesting because I don't think it's as important as iron ore for this company. And you can just see the chart. The share price is down, even though copper is moving into an uptrend. BHP is not. So the market recognizes that iron ore is still the main commodity for BHP, when I think management are probably going the other direction. Okay, so it's iron ore. No interest in that commodity just yet. Uranium. Ugly. There was a podcast. Who was it? It was about uranium. So there's a lot of uranium bulls out there. But the question is, why is uranium falling? And to me, I will never be a bull or bear on any commodity. I just look at the chart. And at this point in time, you have to be a bear on uranium. And I'm not sure why it's falling, but it is falling. It's an ugly looking chart. So this is a Sprott physical uranium. It's been ugly for a while. And yeah, I have no interest in uranium companies right now just because of this chart. In fact, we had a really pretty good bull run. It got really overheated, mind the pun, uranium did, when it got to about back in February 2024. And that was just over a year ago, and it's fallen a fair bit since then. So no interest in uranium right now, but that can change. Oil, the one thing about oil is oil right now is in this purple box, and that's my oil support zone. That's time maybe to become interested in oil. I don't think oil would fall below that zone, and the whole reason I don't think it would fall below that zone is because it's, I think the only way it could fall below that zone is if we do go into a deep recession. Maybe not even deep. If we go into a recession, I think oil could fall below that zone, but otherwise, I don't think it will. But anyway, I could be wrong. But that's a very important zone for oil. And if it does fall below that, then I think, oil would be in a downtrend. If you have a look at the daily chart, it does look a little bit negative, but again, it has found a little bit of support at about $66. What else? So we got gas, lithium, coal. Coal had a bounce, but then has pulled back. Tin for those who didn't see, tin had a really good day on Thursday because of a mine closing in the DRC, Democratic Republic of Congo, because of hostilities or something going on there. Not sure what's happening in that country. Interesting enough, tin is right at a resistance level, and it is sort of struggling to get above that level. But tin looks pretty good at this point in time. Now, I'd love to see it get above this level. That would be a sign of strength. We can move on from nickel, palladium. I noticed Zimpats went on a bit of a tear the other day. I'm not sure why. Zimpats. So when I think of palladium, I think of Zimpats. And yeah, this one a bit of a tear. I'm not sure why. They're a multi-miner. They mine quite a few commodities, but when I think of Zimpats, I just think of palladium. And what about cocoa? Cocoa's dropping like a rock. That's great. Okay, so that's commodities. If there's another commodity you'd like me to look at, just leave it in the comment section. Maybe you'd like me to look at beef. Who knows, beef or pigs? Or maybe they call it swine. I have no idea. I wonder if they call it swine. No. Maybe they just call it pigs. Pig. Where would this be? Futures? Beef? Where's my beef? Here we go, beef stocks, cattle farming. Anyway, let's move on to crypto, and these are both looking fairly weak. Weak. Crypto is looking a little bit weak. A lot of enthusiasm in the crypto space because of Trump. You can definitely see crypto going on a massive spurge. Here it is, the 6th of November. Crypto on that particular day rose 9%, and that was a breakout for crypto. And all that enthusiasm is now turning sour quite quickly. And I would even say there is a correlation between the stock market and crypto. And I don't think it should be there. There is not a correlation between gold and the stock market. And if Bitcoin wants to be sort of talked about in the same breath as gold, we can't have this correlation between this particular asset and the stock market. They should be non-correlated. That's the way I wish it would be. Anyway, and Ethereum, even worse than Bitcoin. In fact, Ethereum fell below a nice little support level at 2,100. This happened like a week ago or so. So Ethereum does look pretty weak. A lot of volume coming in the last few months as well, but the price of Ethereum keeps on going down with this volume. So maybe a lot of people are selling their Ethereum. If you have a look at the weekly chart for Ethereum, it's it's lowest it's been for like a year and a half. So it's not that troubling, but still a bit of weakness in the crypto space. Now on to bonds. We have seen bonds pull back, but a little bit of a rally in the last few weeks. How strong this rally is remains to be seen, but it has reached the 25-day moving average. So we start to see it fall. That would be a sign that the market is expecting maybe interest rates to drop. Maybe. I think there's a little bit of uncertainty right now, even in the bond market, what's going to happen in the future, which is understandable. And last of all, currency. How's this Aussie dollar doing? No, come on, bounce. We want it to go to $5 per American dollar. That way I can have a really cheap holiday. That'd be great. That means accommodation in America will be like $10 a night, or maybe $20 a night. That'd be awesome. I could stay there for like 5 years. Anyway, maybe not 5 years. I don't want to do that. Okay, now on to individual companies. And what I'm going to do is have a look at weekly charts. And instead of looking at 25 and 100-day moving averages or weekly averages, we'll have a look at the 200-week moving average, because I would consider most of these companies to be high quality. At the very least, there is debate whether these companies are high quality. I'm just looking at right now the list, and a few companies here, I think they're debatable. And the reason I've included some of these companies is just where they are in relation to the 200-week moving average. That's it. Okay, so the first one is Wisetech. So Wisetech, this is a weekly chart going all the way back since they listed. And I think there would be very little debate on whether this company is high quality or not. Now, you could debate about the management and the founder and CEO, Mr. White, but when it comes to how this company has performed and the potential in the future, I don't think there's much doubt. So in the past, we have seen, well, by the way, this company listed back in 2016, so we only started seeing the 200-week moving average in 2020. And when we started to see the 200-week moving average then, that was during the COVID-19 financial panic, and the share price was below that 200-week moving average for a very short period of time. And that's the only time the share price has been below. But on occasion, share price does pull back to near the 200-week moving average. Back in June 2022, October 2023, and right now. So is this the time to buy some Wisetech shares because of this particular pullback? That's up to you. It's up to you. I think this concern when it comes to the governance, I suppose, in the company has seen people selling. Their results were, I suppose, weaker than expected, maybe, and that has also helped the share price pull back. But I think this could be an opportunity for those who want to buy some shares in Wisetech. The next one is Brickworks. This one I would have a debate. I could consider this company maybe to be high quality. I wouldn't define it as high quality. I would say quasi-high quality, so it's almost high quality. And if you do have a look at the weekly chart, it does have signatures of a high quality company. I'll just get rid of this uptrend. Just by looking at the chart, it does have signatures of a high quality company. Not as good as maybe some other high quality companies, but share price generally has been in an uptrend. And when the share price does fall below the 200-week moving average, is a great time to buy. But it does fall below the 200-week moving average quite often, and it fell below the 200-week moving average for a long period of time between 2007 and 2012. So during that period, if we were back in 2011, and if I looked at this chart, I'll probably say, nah, maybe it's not a high quality company. But since then, every single time it falls below the 200-week moving average has been a time to buy this company. And you've probably done fairly well if you've done that. And what have we seen in the last week? It's fallen below that level. Fallen below that level on strength. So it might drop a little bit further, but maybe now is a time to think about buying some Brickworks shares just because the share price has dropped a fair bit. Again, I'll leave that up to you. Cochlear, definitely, I think it's in the realms of a high quality. Definitely in the realms of high quality. My problem with Cochlear has always been valuation, and I've been quite disappointed with some of their growth over the last few years. So that's probably been my main problem with Cochlear. And when I say that, if you have a look at their growth, Cochlear, I mean, they definitely have a moat. So revenue growth over the last 5 years has only been 9.3%. Earnings per share over the last 5 years has only been 1.3%. So revenue growth, I'd like that to be a little bit stronger, but the earnings per share growth has been weak as well. And the PE ratio, 46.2, has been always a little bit higher than what I would like based off their lack of growth. Well, not lack of growth, but the growth we are seeing. So I do think the market does tend to overpay for this company based off perceived quality. But I do think this is a high quality company. And the share price generally is well above, maybe not well above, but it is above the 200-week moving average. It's been like that since 2014. Now, there was problems in this company back in the early 2010s. I can't remember what happened. I do remember a colleague of mine did a paper on Cochlear, even though he works for the Weather Bureau. And I didn't know much about Cochlear back then, but it was something wrong. Something wrong was going on. I can't remember what. That was a weak time. Share price didn't do anything for quite a few years. But then the company came out of that moribund period, and share price has performed fantastically well since then. So the past 10 years. And whenever the share price falls at or below the 200-week moving average has been a great time to buy. And lo and behold, look where it is right now. Share price of Cochlear is right on the 200-week moving average at $260. So maybe now is a great time to buy Cochlear shares. CSL, this one's a good one. I do consider CSL to be a high quality company. Now, they also have had some growth issues, but I have not been as disappointed with CSL. Now, revenue growth has been above 10% over the last 10 years. Earnings per share has been a little bit lower. So that's my main concern is earnings per share hasn't been as strong as what I would like, and has been falling away. So last 10 years, earnings per share has been growing at 7.2%. Over the last 3 years at 3.6. So I'd like to see a little bit more growth coming in, but there's no question that this is probably a high quality company. Probably, even though they are struggling with that growth. I'd like to see a little bit better growth. But the main thing about CSL is it's going through a consolidation phase, a long consolidation phase, which has happened to this company in the past. In fact, it's been going on for 5 years. 5-year consolidation phase. And we saw this happen, maybe not 5 years, but we saw this happen between 2007 and 2012. Yeah, a 5-year period where the share price did nothing. Share price did nothing. And then it fell below the 200-week moving average and stayed below for a period of time, for maybe not quite a year, for about 9 months. That was a time to buy. Now, that was in 2011. Yep, started 2012. That would have been a great time to buy this company at about $32. And then the share price went on a massive tear, beautiful uptrend, and now we see another consolidation period. A little bit different because the share price has fallen below the 200-week moving average on 3 occasions. And the other thing I should mention is the share price is at a really nice support level. This level is around about, we'll say in between $240 and $250, currently at $250. During this 5-year consolidation period, whenever the share price gets this level, it has been prime buying conditions. So I'm surprised no, I should rephrase that. I would not be surprised to see a really good bounce in CSL. The other thing is the P ratio of CSL is now below 30. Based off trading view, I think it's below 30, 29.02. And if we have a look at historical levels of PE ratio for this company, go to ratios. PE, in fact, according to FinChat, the PE ratio is 27.9. This has been the lowest. This is the lowest PE ratio for CSL since 2017. 2017, and back then the share price was like $100. So the share price has increased two and a half fold, but the PE ratio is now below where it was back here. So there would have been a lot of enthusiasm around this company back then, and it just shows you what happens to or during consolidation phase. Share price goes sideways for a long period of time, and that is, and if the company is growing, and CSL is growing, so that means this company is going through multiple contraction. The P ratio of the company is dropping. We can see that. P ratio of this company has been dropping over the last few years, even though it's growing. So the company is becoming better and better valued. The valuation is becoming better and better. And eventually we're going to see value investors go, hey, I think there's opportunity now in CSL. When in the past, say 6 to 10 years, they've always thought it was overvalued. Anyway, so CSL is another company, another high-quality company whose share price is below the 200-week moving average. And not only that, share price is at a support level. Reece's Pieces. No, Reece Limited, not Reece's Pieces. This is definitely a debate whether this company is high quality. Someone did ask me about this company within the last week, I think. And I had a look in regards to P ratio, and I thought this company was intriguing or interesting at these levels. And then I had a look at the chart, and yeah. So if you go all the way back, this company share price has been above the 200-week moving average for the past 13 years, and then it drops below it for brief periods, and that's the time to buy. So we're talking about, of course, during COVID-19, also during the overall weakness in the markets in middle of 2022. So we saw the market reach a double bottom June, October 2022, and we also saw Reece hit a double bottom. That was prime buying conditions. And now the share price has absolutely collapsed. In fact, the share price has dropped from $29 to $16. Possibly the market is overreacting, but this could be good buying opportunities for Reece. So it all depends on your position when it comes to the quality of this company. Is Reece a high quality company? Now may be time to buy. Steadfast. So Steadfast and is it AUB? This is a brilliant looking chart, by the way. So this company listed in 2013. And what can you say about this chart? A beautiful uptrend. Only once has the share price fallen below the 200-week moving average, and that was during COVID-19. And we have seen the 200-week moving average act as support during the past few months. Now, in September, it fell a fair bit, and that was based off that Four Corners program. And the share price actually bounced right off the 200-week moving average, perfectly bounced off the 200-week moving average. And the share price right now is just above that moving average. So this could be a good time to buy Steadfast Group. But again, what is your opinion on this company? Is it high quality? Just based off the chart, I think there's definitely an argument. This is a high quality company. Infratil, this is one where I think there would be massive debate about this company. Is this company high quality? Now, I would take both sides. I personally wouldn't say it's high quality, but the chart tells me something different. Again, this is the 200-week moving average starts in 2018. It listed back in 2010. And only once has the share price of this particular infrastructure company has fallen below the 200-week moving average during COVID-19. Great buying, great buying at that point. And the share price is getting close to that 200-week moving average. It's not far away. So that 200-week moving average is at 877, share price at 925. So this could be great buying opportunities for Infratil. Lovisa. So this is a company I own. I was thinking I don't own many of these companies, but I do, don't I? I own Wisetech, CSL, Lovisa, NextDC, And then once we go into American companies, I own a few of those as well. I'm going to get rid of this uptrend line just to make it a little bit clearer. I definitely would consider Lovisa to be a high quality retail company on the ASX. And that's on the premise of them expanding overseas or successfully expanding overseas. And I think they're doing a pretty good job there. This company listed back in 2015, and there was a period of time where this company was not liked. There was I still remember this massive drop in this company's share price back in January 2016. In 1 week, the share price dropped 37.5%. And share price dropped all the way down to like 230. I still remember that and thinking, yeah, whatever. It's only a jewelry company, who cares? But my opinion on this company has definitely changed since then. Now, if you have a look at this chart and the 200-week moving average, again, just like many other companies, share price of this particular high-quality company fell below the 200-week moving average during COVID-19. And since then, you can see it bouncing off a 200-week moving average in June 2022, and then again in October 2023. And look where the share price is right now. It's right on the 200-week moving average. Is this going to be another bounce off that particular moving average? So this is a potential good buying opportunity for this high-quality company. Probably the only argument may be valuation. I haven't looked at valuation, by the way. So this is a long-term hold for me, and I tend not to look at these companies all that often. But I went through the charts of high-quality companies. I saw where the share price is, and I thought, oh, this could be an opportunity. NextDC, this is one where, just like Infratil, I think there's a lot of debate around these companies. Are these companies high quality? Because NextDC is not profitable. They spend a lot of money on capital expenditure because they have to build out the data centers. That needs a lot of money, always coming back to the market for more and more money. I sort of do have a problem with that, but I do like the data center space. But if you do have a look at the weekly chart, the thing that cries out about this chart, again, it has a characteristic of a high quality company. Very rarely does it fall below the 200-week moving average. Only once has it done that. That was during that weak period in 2022. And remember, the whole reason the market fell in 2022 was because of rising interest rates. And that would negatively affect NextDC more than some other companies because the future profits in these companies are well into the future. And you have to you have to decrease the value of those future profits with high interest rates because present value is different. Anyway, look where the share price is right now. Share price is right on the 200-week moving average for NextDC. So is this a high-quality company? And if you think it is or has the makings to be a high-quality company, I think that's the best way to play this. This company has the makings to be a high-quality company. Not sure it's there just yet. And the share price has reached the level to maybe think about buying in. And actually, no, we've got two more Australian companies. Next one is Macquarie Group. Macquarie Group. I am less enthusiastic about this company than other people. And the reason behind that is I did a little bit of research and I just think the growth in this company is a little bit weaker than what people think. By the way, yeah, I'll just show you why. MQG. Yeah, so revenue growth over the last 5 years is 5.6%. They don't have 10-year here, so maybe it's not growing. And earnings per share over the last 10 years, 8.7%. Last 5 years, 1.4%. Last 3 years, negative 4%. Dividend per share growth is only at 8.3% over the last 10 years, 1.1% over the last 5 years. So I do think there's a lot of, I wouldn't say misplaced enthusiasm in this company, but I do think there's a lot of people out there, experts even, who have a higher opinion of this company than I do, which is not a bad thing, I suppose. PE ratio currently at 20.3, which I think is a little bit stretched. However, if you have a look at the chart, and the other thing I should say is this company went through a lot of pain because of GFC. Share price dove significantly. Share price went from $100 down to less than 20. So share price dropped, what's that, 80% drop in share price? I have heard that this is a completely different company since then, and the share price broke out back in late 2012 at $35. And since then, share price has remained above the 200-week moving average quite consistently, except during COVID-19. And whenever it touched the 200-week moving average is the time to buy. So we're talking about February 2016, October 2022 and also October 2023. And the share price is moving towards that level right now. So if you do like this company, if you do think this is high quality, now is the time to maybe put this on your radar if the share price does fall a little bit more. Wouldn't take much for the share price to drop to that level. And finally, Spark. The reason I've included Spark is I might have considered this company to be high quality. And sometimes you could get it wrong. So I might consider this company to be high quality. And the reason I would have considered that is if you go and have a look at the chart from 2013, share price consistently bounced off the 200-week moving average. It happened a lot. 1, 2, 3, 4, 5, 6, 7 times. But the 8th time, it just fell through and continued to fall. And then I had a look at the longer chart and went, oh, yeah, I don't think this is high quality. I think this company goes, this is way more cyclical just by this chart. And we're now in a down cycle period for this company. Share price has just collapsed. So this is the reason I'm pointing this out is I think it's very important to stick with high quality companies when it comes to this strategy, because as you can see, if you get it wrong in your determination whether the company is high quality or not, you can get it wrong and quite wrong, because I think some of those people might be buying this company on that dip back in March 2024, just 1 year ago. They're buying on this dip. Share price dropped below the 200-week moving average. Oh, great time to buy, but it was not. Share price has more than halved since then. So I think it's very important to know whether a company is high quality or not, and I would not consider Spark New Zealand to be high quality. Okay, now on to some international companies. I'll go through these a little bit quicker. So the first one is Novo Nordisk. So this is Ozempic, what do we call that? Other drugs. Definitely has the makings of definitely based off the weekly chart, is a high quality company. If you go all the way back to the early 2000s, share price very rarely drops below the 200-week moving average. And when it does, it's great buying conditions. Now, I think the market got way over enthusiastic. Even I got way over enthusiastic when it came to this company. I did buy on this uptrend. Share price has fallen. Share price has almost halved. And the share price has dropped below the 200-week moving average. Could be a good time to buy some Novo Nordisk. And it's not that expensive either. I had a look at the valuation. It's not that expensive. It's not that market cap is $2.35 trillion. Is that right? That doesn't sound right. Crowdstrike. This one's interesting. So this one listed on the stock market 2019. Remember that what was it? Some issues with their. So this is protection. What do you call it? Security, internet security, whatever you call it. And they had some problems. That's why the share price dropped like a rock. Back, when was this? This was back in July of last year. And the share price just dropped significantly. And that, for me, was a buying opportunity because I thought the market's going to forget about this fairly quickly. Companies will forget about this. This was prime buying opportunities. And finally, enough, the share price bounced off the 200-week moving average almost perfectly. It was almost perfect. Look at that bounce. Beautiful bounce. And this is just showing you that, and I would consider Crowdstrike to be high quality. And this just shows you that sometimes that 200-week moving average can act as support. And we have seen that. I bought just above that moving average. I'm not going to time it to perfection, but I thought this was prime buying. This was a prime opportunity to buy this company, just like with ResMed, with Ozempic back in late 2023. This one surprised me. The next company surprised me. Now, I have a lot of companies in my USA watch list, and does include McDonald's. And then I had a look at the 200-week, the weekly chart, and gee, what can you say about McDonald's? Look at this chart. It's a fabulous chart. They must have listed in 1968. Anyway, if we go back to, say, 20 years ago, so if you look at the last 20 years for McDonald's, look at how the share price responds to the 200 moving average. This is one of the reasons why I think Charlie Munger says a great strategy to beat the market, and not only beat the market, significantly beat the market, is find high quality companies And when the share price falls to the 200 moving average, buy those companies. This is a prime example. So McDonald's. I can't believe I'm talking about McDonald's. Okay, so very rarely does this share price of this company fall to the 200 moving average. It does, but and we're talking about 2008 during the look at the GFC. The share price of this company barely fell. Share price fell below the 200 moving average in 2015. Share price went sideways for a period of time. Look at that. Share price of this company went sideways for 3 years. So even for high quality companies, share price can go sideways. And I think a lot of investors would get bored during that period and they just sell. And that could be a mistake. Also, during COVID-19, it fell. And it hit the 200-week moving average back in July of 2024. That was a time to buy. By the way, share price is not near the 200-week moving average. But this was a surprise to me. This is the chart of a high-quality company. And I never thought I would say that about McDonald's. I say what you will about the food. This chart is the chart of a high-quality company. Now on to a company I don't think anyone would have any qualms calling it high quality, and that is Berkshire Hathaway. Berkshire Hathaway, I'm so disappointed with myself because wasn't during COVID-19, back in September 2022, I was on the cusp of buying shares in Berkshire Hathaway. I was so close because I was buying a lot of American companies back then, and this was one of the companies I almost bought, and the share price dipped back to 200 moving average, very close in October 2022. Share price at that point was $260, and the share price has doubled since then. And if you go back through history, that's the time to buy this company. Look at that. Beautiful chart. By the way, the reason this doesn't go back all the way back to when this started trading, probably 1960s, I think, was because Berkshire Hathaway B shares. So these aren't the real shares. These are the B shares, which goes back to 1996. But even then, you can just see the time to buy the shares in this company is when a share price falls below 200-week moving average. So that's Berkshire Hathaway. Not there yet, but I just wanted to show you examples of high-quality companies. Another one example is Visa. There's no debate that this is a high-quality company, and this is another company that I almost bought during that weak period in 2022. And look at that. The share price briefly fell below the 200-week moving average in October of that particular year. I even put a downtrend line. Don't know why I didn't buy. I even put a downtrend line in Visa's chart. There it is. It's right there. Then it broke through in December. Why didn't I buy? Because that was prime buying conditions. The share price touched the 200-week moving average during COVID-19, but fell through in October 2020. This is a chart of a high-quality company. Visa, I think MasterCard would look fairly similar. Okay, so Trade Desk. Okay, so now we're talking about companies. I'm not sure if they are high quality, but Trade Desk might have the makings of a high quality company. Share price has been in uptrend since they listed. Share price briefly fell below the 200-week moving average in 2022. Went on a really good tear. Share price has absolutely collapsed. Is this a buying opportunity for this company? I haven't done any major research on this company, but I do think this could be an opportunity. So I'm going to do some research. Is the market overreacting? Because the share price has dropped significantly below that moving average. Now, there is a chance that this could be a trap. Yeah, a trap. We'll call it a trap. Sort of like Spark New Zealand. So I won't rush into buying this one, but it's really interesting the share price has dropped significantly. In fact, the share price has more than halved over the last 5 weeks. So obviously they released some disappointing results. But I have found with American companies that does lead to really good buying opportunities. When the company releases disappointing results, can lead to opportunities. So it's Trade Desk. It's a pretty big company. Market cap is $26 billion. And I'm pretty sure the company is profitable. Yeah, in the last year, they made $2.44 billion in revenue and profit of $393 million. So the company is profitable. This one's an interesting one. I don't know anything about this. TJX. I do notice there is a TJX shop at one of the local malls. I don't know if it's the same thing, but I had a look at this chart. I went, oh, this is another high-quality company just by looking at the chart. Look at it. Geez, this goes way, way back. This goes way, way back. So this really became, maybe had the first signs of high quality back in 1996. And then whenever it pulls back below the 200-week moving average, you just buy. You just buy. It does it on occasion, and you just buy. Buy, buy, buy. Right now, it's well above the 200-week moving average. So this is definitely another company I probably should do some research on. TJX Companies. They must be doing something right for that sort of chart. This sort of chart is just an amazing chart. So definitely one I'm going to put on my watch list. I don't think I have. I do have a USA high quality watch list, and I'm going to put this into that. I should do research on it first, though. Pepsi. Yes, Pepsi. They don't only sell Pepsi. They're really diversified. They sell snacks, drinks. I would say this is, it probably doesn't have the growth I'm looking for when it comes to high quality, but definitely if you like that slow burning growth and maybe some value. What's the value of this company? Let's say P ratio is 21. Maybe I'd like that to be a little bit lower. But if you do have a look at the history of Pepsi, just like some of the other companies, it has the qualities, has the characteristics of a high quality. So this goes all the way back to the 1980s. And on occasion, it falls below, share price falls below 200 moving average. And that's the time to buy. Buy, buy, buy. So we've seen it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times in the past, 30, 40 years. And right now, the share price is below the 200 moving average. I'm not sure if this is a bit of a trap. Share price has dropped a fair bit from almost $200 to $148, but maybe this is an opportunity. Maybe this is an opportunity. I'm just throwing it out there. The next one is ASML. Okay, so this one is going to be highly volatile. I had a quick look at the valuation. It doesn't seem that overvalued, but again, just based off the 200-week moving average, possible buying opportunity for this company. Just possible. I'm going to put it out there. A company I know nothing about. This one is called Monolithic Power Systems. No idea what they do. No idea. I just saw this chart because I was going through heaps of companies, and I just saw this chart. I went, okay, it's a nice looking chart. If you have a look at the long-term chart, it's pretty good. It's looking pretty good since 2012. Looks like it listed in 2005. Did nothing for about 7 years. But once it really broke out in 2012, it's done a pretty good job. It's gone from $20 to $606. So it's been a 30 bagger since then. And yeah, whenever the share price drops to the 200-week moving average, has been a good time to buy. And right now, it's just above it. And now the share price dropped a fair bit back in October. So obviously the company released some disappointing third quarter results. And the share price hasn't really bounced since then. So I don't know. I know nothing about this company. It has a market cap of $29 billion, P ratio of 15.5. It had an abnormal, or maybe that's P ratio is because they had some abnormal profit in the last quarter. Yeah, they had revenue of $621 million and a profit of 1.45. So there must have been a one-off in there. But interesting looking weekly chart for Monolithic Power Systems. And finally, the last one is, I don't know this one, CACI International. Look at the massive increase in volume since November as the share price has pulled back significantly. Share price has gone from 580 to 370. But if you go back through time, again, characteristics of a high quality company. Particularly since 2013, share price did nothing for about 7 8 years, just like Monolithic Power Systems. And the share price has pulled back significantly and looks like it has bounced off the 200-week moving average almost perfectly. So this might be another little research project for NEPI. Yeah, market cap is 8.4 billion, P ratio 17.24. Let's have a look at the growth. Nice, not amazing growth in revenue, but revenue is 7.66 billion, profit of 419 million. What does this company do? Engages in the provision of information solutions and services in support of national security missions and government transformation for intelligence, defense, and federal civilian customers. Okay, cybersecurity, one of the things they do. Okay, so that's all I got for this particular technical update video. Went a little bit longer than I expected. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.